All right, good afternoon again, ladies and gents. Good afternoon, Lee Sheehy. Good afternoon again to you too. So, Bank of Canada, not as much prep to do for the inflation data now. So, of course, if you did join me for CPI, it did come in lower than expected, and compared to the prior, there's a whole point difference, a whole percentage one percentage point difference with the CPI year on year and the actual prior and the actual figure. That's some good news for the stock markets there. David Rodriguez says, good afternoon again. Good afternoon to you again. So Bank of Canada, let's get into it. Let's kind of go through all the prep with this here. So how does it affect the markets? And of course, what is the rate decision? So of course, it's the rate that the central bank sets, the overnight rate for Canada, and of course, ups and downs. If you do set the rate higher than expected, or if the rate is quite high, that will usually mean that the central bank is trying to bring down productivity or slow down growth, or maybe slow down inflation, which is the current target, which is the current objective, let's say, for the Bank of Canada. And then on the flip side, whenever rates are very low, that is supposed to drive growth, consumer spending, and also to drive inflation if it's way below the central bank's target of inflation. Don't forget, if you are joining me again, to share the video, subscribe to the channel if you liked the video last time, get the word out there, and let's go through this a bit more detail. Now, how does it affect the markets? So with the currency, very easy. If you do see that the central bank is more hawkish than expected, let's say they do decide to do a 25 base point hike, or they have a hawkish monetary policy statement, then that can lead to the Canadian dollar seeing some strength instead, and some further bullishness. For the stock market, inverse happens if the data, let's say if the central bank raises rates by surprise the markets, or has more hawkish monetary policy statement, that will lead to the stock market seeing a decline. Vice versa, if you do see a dovish or more dovish than expected central bank, then that can lead to the stock market seeing an appreciation. And then for bonds, bond yields, if the central bank isn't as hawkish, or is less hawkish than what people would expect, then bond yields could see a move towards the downside in anticipation that the central bank is less inclined to mention that they're going to sit and wait, and they might be more inclined to say that we've done our job, and that will lead to bond yields going down in anticipation that the rate will just stay as it is, and there is an expectation for cuts to come in sooner rather than later, which would again add to further downside movement in the bond yields. And in inverse, for bond prices would see a move towards the upside instead, as they become less attractive and the stock market becomes more attractive instead, if the economy is being supported, or if the economy doesn't, if businesses don't have to face high rates. Good afternoon, Eugene. Good afternoon to you again. Well, maybe this is your first time. There was a lot of people on last time, so excuse me if I do say if you're on last time. So where is the economy at the moment then? So inflation, 5.2% compared to 5.9%. GDP data, quarter annualized rate flat versus Q3 of 2.9%. Employment data was at 34.7K compared to the prior of 21.8K. Average hourly earnings are down as well, 5.2% compared to 5.4%. Unemployment rate remained unchanged at 5%. Retail sales was at 1.4% compared to the prior of 0.5%. PPI of 1.4% compared to 5%. So huge drawdown or huge decline in inflation from the producer side of the economy, which should mean that inflation sees a considerable amount of decline, hopefully further on down the line. RMPI, or the Raw Material Price Index, was lower as well from the month-on-month at minus 0.4% compared to minus 0.1%. Then the previous Bank of Canada rate decision that we had on March 8th. So the Bank of Canada statement dropped the January language about the economy remaining in excess demand. Okay. And then also repeating that it expects to hold key rate at its current level, conditional on the economy developing broadly in line with its forecast. So remember, if there's excess demand within the economy, that means that those consumers and businesses are buying up more goods or have a high demand for the goods and services that are available within the economy. And that drives inflation. So if the Bank of Canada recognizes that there isn't that happening anymore, then which is what they did last time around, they drop that language, means that they're less hawkish and they're more in favor of going towards the dovish side and maybe pivoting sooner rather than later. Then, of course, other than that, there wasn't really anything new or exciting from the Bank of Canada. They just reiterated a lot of the stuff that they had said last time, that they were willing to raise policy rates further if necessary to return inflation to the 2% target. So more of saying, yeah, we've done our job with getting inflation in moving in the right direction and getting it quite low to where it is at the moment now. If inflation pressures do pick up again, then we're ready to raise rates to curtail that inflation if necessary. Meeting minutes from this is the second meeting minutes that we would have received from the Bank of Canada, completely new, of course, at the request of the IMF. They said that the resilience of the US economy to high interest rates, as well as the persistence of elevated core inflation, might foreshadow similar developments in Canada. Now, we've seen with today's CPI report for the US that the core data, right, has been stronger. We know that core CPI year on year was higher than the previous, at 5.6% compared to the prior 5.5%. And that's something that the meeting minutes have highlighted, that if the core data shows more resilience, that could make the job for the US tougher. But then also within Canada, it's going to be tougher for them because, of course, if they're next door to each other, there's a lot of trade that happens. If prices increase for goods and services, then that's going to have a big impact on Canada and how they deal with monetary policy or fiscal policy as well, to try and manage inflation as best as they can. Saying that it was critical to emphasize the conditionality of rate hike pause as the Fed continued to assess whether monetary policy was restrictive enough. As said, everyone is looking at no change. The data hasn't been surprising to the upside. There's been nothing scary or horrifying enough for the markets to go, maybe we should switch back and maybe we should expect the central bank to hike rates instead. That hasn't happened, fortunately. So the markets are still looking at a rate pause, but they're saying there that, it's on a conditional basis as long as inflation is headed downwards and that employment doesn't get too out of hand and productivity doesn't explode. If we carry on. So the Bank of Canada surveys on April 3rd, that's what's quite important from a business perspective and consumers perspective as well. So firms continue to see the labour market as tight, despite the fact that labour shortages and wage growth pressures have eased. Businesses link expectations of weaker sales growth to rate hikes, high inflation, and concerns over recession. So more or less as what the Bank of Canada is expecting and was expecting from consumers and businesses, is that you do see weaker sales and weaker growth because of these very strong rate hikes and very quick rate hikes that the central bank has taken in such a short amount of time. So, and then of course the idea or the thought of a recession, that again the Bank of Canada has talked about in the past, and other central bank members and other central bankers have talked in the past as well from other nations, is that there could be a chance of a soft landing for the economy. So a bit of a dip, but it depends on how the central bank can contain the fallout from the high rates, and what does the government do as well to kind of aid that as well. So do they let it become a soft landing, or does it become a deep recession? The overall business outlook survey indicator was at minus 1.1 over the fourth quarter, and it was, if we're looking at quarter over quarter, if we're looking at the previous quarter, it was minus 0.06%. So you can see that it is slightly worse than the previous outlook survey indicator that we'd seen last time, but not a huge. But you can see that, but that's more or less as expected from what the central bank is looking for. And in order to, and if businesses are looking at a weaker economy, then the central bank has more or less done its job to bring down inflation and bring down productivity. Otherwise, it just becomes an endless cycle, and then things just repeat over and over again, and the central bank isn't able to manage or handle inflation well, and then they would lose credibility. So Bank of Canada views March 9th, you had Rogers saying it's a conditional pause, again what had been reiterated by the Bank of Canada previously in the meeting minutes. Gravel said that the bank's quantitative tightening program will most likely end around the end of 2024 or the first half of 25, and quantitative tightening is working, but it will take some time to complete its course. So you've got to think, so you have the tightening of monetary policy with rates, and then you have the tightening of the quantitative easing that they've done, and cutting and slowing down or removing some of the assets that the central bank has on its books of government bonds. So again, they're managing in a way where there is a slow down, or they're trying to slow down the economy in the best way that they can. Not too slow, but slow enough that things can still trudge along nicely within the economy to an extent. But they're expecting that to be to end quantitative tightening at the end of 2024. In the US, you've got traders that are expecting the central bank to cut rates before the year is out, as early as July, right? But if the central bank in Canada is looking to, if you have comments from them looking to end quantitative tightening around 2024, that's quite a long way away, and it means that the idea of a rate hike is pushed out or isn't being accepted by the central bank. So that's one thing just to be aware of, is that you have a slight difference in when the central bank should start easing monetary policy compared to what the markets are saying or expecting. And she also added, they also added that in the event of severe market stress, the Bank of Canada stands ready to act and provide liquidity support to the financial system. That's kind of obvious. And again, saying it's way too early to talk about normalizing rates down. So again, what I just said earlier on, that they haven't, got to the 2% target yet, really, and that they've got to wait for more data to see a continuation of a slowdown within the economy, enough for them to pivot and say, right, now we got to go dovish mode and start cutting rates instead to keep the economy from going into a deep recession. Sentiment and views. So March 8th, on the last rate decision, good to understand the historically what's happened and what could happen in the future. So they said that aggressive rate increases by the Fed might put pressure on the Bank of Canada to also raise rates. If the Fed funds rate moves to 5.5% range, that could force the Bank of Canada to raise rates. Now, with inflation today, if in the US, they get to Of course, if they get to, let's say, if the expected rate hike is for 5%, and then if inflation the next round comes in higher than expected, or there is a bit of data that is much higher than expected, and they go for another 25 instead, that's a surprise. And that's not what the Bank of Canada would want, because if there's 100 base point difference between where they've paused and where the US is, say if they do get to 5%, that puts a lot of downward pressure on the Canadian dollar, which again, if the Canadian dollar loses its value, becomes devalued. It means that things in Canada would become cheaper compared to the US, and that could mean that prices start to rise again if the value of the Canadian dollar declines. So there's a balancing act that the Bank of Canada has, or there's a leeway amount that the Bank of Canada would allow, rather than letting the rate of the currency getting it out of hand, or letting it get out of hand. So that's one thing, as historically, of what was said before, but seems less likely now, considering how weak the CPI data was today. Well, let's say good if you're thinking about the stock market. 10th of April, we had James Orlando talking about the business surveys, or the different Bank of Canada surveys that were done, that the report isn't enough to pull the bank off the sidelines. And again, that's according to economists at Toronto Dominion Bank in an investor note. So the idea of the businesses feeling that there's more of a likelihood of a recession or a decrease in or weaker sales, that's not going to be enough for the Bank of Canada to flip their switch, because it's what they expected. If businesses said they see a severe stress, or expect severe stress, or are experiencing severe stress within their businesses, or experiencing a very anemic sales, then the central bank might step in and go the other way. But that hasn't been said so far as of yet. It's more of that businesses are worried that things could become a little bit worse than they are at the moment. RBC's CEO McKay said increasing interest rates have taken down certain lenders who made terrible bets, but global financial system is in good shape overall. So remember with the SVB fallout, Credit Suisse fallout as well, how that rocked the market, and how people were referring to that to thinking about how that was 2008 all over again. Again, we haven't seen any other banking news, to be honest. Everything has been very, very quiet. You've had quite key headlines that have come out in the past, where you've had, let's talk about the US. So small to medium-sized businesses in the US, medium-sized businesses in the US, banks wanting to look into the FDIC to provide, shore up more or less liquidity for 2 years, or deposits, not liquidity, deposits for 2 years. And that was something that's quite concerning. And now there are no more headlines that are coming out. It seems as as if it was just a one-time event, and that's it. Things go back to normal. So that's what. So with McKay, again, whatever happens in the US is going to have an effect, a knock-on effect in Canada. But McKay is saying that more or less those who made terrible bets have been dealt with, and the economy but the financial system is strong enough to kind of deal with that. All right. So this is the last rate decision then. So here we are. So it's about 10 seconds before the last rate decision that we had last time. If we kind of just play the video, you can see that, one, there wasn't too much of a market reaction overall. And two, the statement didn't really help, or didn't really provide any further strength to the Canadian dollar. So you can see here that the data, it was as expected. It was for no change. And then the markets just kind of You did see a little bit of a pop on the dollar CAD, but other than that, there wasn't really too much of a reaction to the news that had come out. So again, if you do have access to the deviations for the economic release, the Google sheet that I provide you guys, you can see there what I said was that there was nothing new came out from it. From the Bank of Canada, they repeated they expect to hold the key rate at its current level on conditional that the economy developing broadly in line with its forecast. So again, there wasn't anything out of the blue or surprise. One thing to be aware of though, what could we define as dovish and hawkish today with the Bank of Canada? So the dovish comments would be if the Bank of Canada highlights, let's say, what the Bank of Canada surveys have been saying, that there's an expectation for more of a recession, more of a chance of recession to occur than not. And if they say that there is maybe there's a deep recession that's expected, that would be very dovish. Then you'd expect to flip back to a pivot much sooner rather than later from the Bank of Canada. But if they do expect a recession in Canada and it to be stronger than they might expect it to be, that's one thing to be aware of. If inflation, if they say it is coming down in line with expectation, it's still high, but it is coming down in a nice and easy way. Again, that it would be seen as dovish. The very dovish point would be if they remove the language of saying conditional. Okay, that's what they said last time around, that the rate pause is conditional. If they remove that language and saying that they stuck with the rate pause and they don't mention the word conditional, that could also help that could also help the Canadian dollar. That could also hinder the Canadian dollar, and you could see some further downside movement instead. So remember, a more dovish central bank leads to a depreciation in that currency. Okay, but let's say that on the flip side, with the hawkish side from the Bank of Canada, if they decide to say that maybe inflation is still too strong, and they keep the word conditional in there with the expectation of rates of pausing rates, if they do repeat that, then there's nothing too big to expect. It'll be if they say that if they expect the economy if they still see the economy overheating, or not really coming down in line with the expectations, that will lead towards the more hawkish side. That could cause some strength within the Canadian dollar, or a little bit of strength. Okay, if they say we need to do one more rate hike, then that would definitely, cause a flip of the switch, and the Canadian dollar will move to the upside if they don't hike rates at this meeting. Okay, if they do decide to go with a 25 basis point hike or a rate hike rather than a pause, that would of course be higher than the expectation, and that will lead to the Canadian dollar to fly instead. And then you'll be looking to the monetary policy statement as to why that had occurred. So key thing is, if the rate comes in line with expectation, you're looking at what the rate statement says to kind of gauge what the market reaction might be, if it's more hawkish or dovish. Don't forget to like this video, subscribe to the channel, get the word out there if you find this content useful so far. And we've got about less than 5 minutes left. Okay, so let's look at the deviations for the economic release. Okay, we can see that the dollar CAD had the biggest reaction last time around. So there was 28 pips towards at the upside. So this shows you the what we're looking here is the initial reaction going to the wick of the candle. Okay, and this is the movement 10 minutes after the release going to the end of that candle, all on a 1 minute chart. Okay, is what I look at on here. Then on the other than that, you can see that the reaction, although the dollar CAD had the biggest reaction last time round, everything else is kind of just plain. There wasn't anything exciting happening. So, and you saw in the video too that the movement wasn't that great when the rate came in as expected. So you can see when the first time is when they talked about the need to hold rates, that you'd seen a bigger reaction last time around, but then when that's repeated, then that's more or less, and there wasn't anything new. You had a very subdued reaction compared to what we've seen previously. Remember, this is all free. This the deviations for the economic release. All you've got to do is sign up to the MACROACE mailing list, okay, and you get an email every Sunday giving you an expectation of what to expect for US, Europe session, Asia session, a short summary, and then also the links to the upcoming deviations for the week ahead, and also the live streams and a summary of the weekend news. It's not big. There's not too much that kind of goes into it. More or less, more of the explanation comes through with me speaking to you here. But that is that there. So looking at the dollar CAD as one of the currencies, we've seen that GP CAD has in the past had consistently the biggest market reaction in the past, and then we had Euro CAD as well. CAD JPY is also quite interesting too. Has been quite decent in the past, but I think if things come in as expected and we get more of a repetition, you're gonna get more of a muted reaction unless there's something exciting that comes out from the rate statement, or shocking, or surprise. All right. So if the rate comes in low, if they decide to do a cut in this meeting without kind of channeling that across through any sort of comments from other central bank members, then you'd expect the Canadian dollar to dip like a dipstick in a bit of sugar, and then take it out and then enjoy that sugar. I don't know if you guys have ever come across a dipstick before. You should have. I know they're delicious. All right, so let's get rid of this. We've got about 1 minute to go now till the rate decision. See what happens. All right, let's get a TICKSTRIKE running as well. Got a Canadian release. All right, so that is that there. Get that out of the way. So kind of take us around. GBP CAD, dollar CAD. Let's go there. Right, there we go. Okay. So here we are. Right. Not too long left now. So I'm looking at Euro CAD, GP CAD, and dollar CAD. All right, 10 seconds to go to the release. We have Robert on the microphone for FinancialJuice at the moment. Let's see what happens. Okay, no change. Rate remains unchanged as expected. Okay, so that's as expected. Let's go through some of the comments then. What we got here. All right. So again, not much of a reaction. It's dead. It's a dead reaction from the markets. Let's have a look. So annualized GDP fourth quarter seen as flat versus 1.3% in January. Q1 of 2023, they see 2.3% versus 0.5%. So a pickup in strength there, or within the economy. In Canada, demand is still exceeding supply and labor market remains tight. Wage growth still elevated relative to productivity growth. Getting inflation down to 2% could be hard because inflation expectations are coming down slowly. Service price inflation and wage growth remain elevated. They're assessing the restrictiveness of rates and prepared to hike again. Inflation is seen at 3% by mid-year and 2.1% by 2024. Yeah, they also say that US growth is to slow considerably. To be honest, yeah, there's just nothing here. It's all pretty much boring. So again, as we've seen there, yeah, rate came in as expected. Didn't get any surprises from the data, so hence you're not seeing crazy moves happening. But you can see that the Canadian dollar is starting to strengthen a little bit more. So it could be that, I mean, they did talk about saying that they're ready to hike again. Well, they're ready to, if need be. It's kind of... Yeah, so they did say they're assessing restrictiveness of rates and are prepared to hike again. Continuing policy of quantitative tightening. So being steadfast in their expectations of, they're not pivoting. They're not going to pivot anytime soon. Basically, they're still waiting for data to come through before they make any decisions. But yeah, you can see there. I think it was the dollar CAD again that had the biggest market reaction. Considering how post the initial move, it does seem to be a bit bigger. So it's about 12.5 pips towards the upside. Okay. And then let's have a look here. So yes, 9.3 up. And EuroCAD. This is okay, and then 11.5 pips towards the upside there on the data on EuroCAD. Okay, that concludes more or less the release for the data. Don't forget FinancialJuice. You can sign up for the free version of FinancialJuice to get your text and data. If you want to get live voice and text data, you can sign up for the pro version of FinancialJuice. The link is in the description here or in the chat here. If you do sign up to the pro version of FinancialJuice, make sure first you have an account on FinancialJuice. If you feel like you're ready to, of course, if you feel like you're prepared and ready to go ahead with a paid version of the service, then go ahead by all means. When you do pay for the subscription, if you're already on the website, make sure you log out and then log back in again. That will act as a verification process, and then you should have access to the pro version, as you can see here that I have, with your text headlines, your live voice feed here, and your economic calendar here, with all your economic data and your upcoming speakers as well. So that is it. Thank you, Lee Sheehy. Thank you, Tony. Have a good afternoon. You too as well. David Dricker. Thanks, Tony, my man. You've Lee's recommended. You've recommended the video to a friend. Thank you very much. I appreciate that. Eugene says thanks again. Thanks, Tony, for your words. Slush says thanks again. Pat Leona says thanks, Tony. All right, thank you guys. PPI tomorrow. I did post a live stream. I did post a playlist for you to have a little look at that. But yeah, all right. A boring Canada. But there we go. All right, take care, guys.